In this video, we take a look at the relationship between the tax burden and the price elasticity of supply and price elasticity of demand. In particular, what we're going to see is that those elasticities are going to determine how the tax is split between the buyers and the sellers. So let's begin. Let's start by taking a look at the market for food. Food has a fairly inelastic demand curve because there are no real substitutes for food. And the supply curve is fairly elastic. So in this particular case, we're going to assume that the price elasticity of supply is elastic or greater than 1, and the price elasticity of demand is inelastic or less than 1. We're going to use a tax wedge here, so let's assume we put in a tax of $1 on food. So we'll draw in our tax wedge. Remember, the height of this wedge represents the value of the tax, or $1, and this quantity would represent the quantity with the tax. Well, the price that the buyer pays is going to go up, and that's no surprise. Buyers are going to pay more whenever a tax is imposed in a market. The seller will also be affected. The seller is going to receive a lower price. But if we take a look here, we see that the amount of the tax that the buyer pays is much larger than the amount of the tax that the seller pays. It's not surprising that the buyer pays more of the tax because there are few, if any, substitutes for food. And when we look at it from a seller's point of view, the seller has a more elastic demand curve, which means that as the price falls, they're going to escape the tax. They're going to produce less food. So more of the burden will be pushed onto the buyer. What about if we have a case where the price elasticity of supply is inelastic relative to the price elasticity of demand? And a good example of this might be tickets to a basketball game. So supply is going to be fairly inelastic. You might even argue perfectly elastic, but let's just assume that as prices go up, maybe they'll put some extra seating in the aisles, depending upon what the fire code is. So if we put in our tax wedge here, again, assuming, let's say it's $1 tax, where the difference between the demand and supply curve is $1, what we see is that the price that the buyer pays only goes up by a little bit. So only a small burden of the tax is imposed on the buyer. Regarding the seller, they incur a much larger proportion of the tax. Why is that so? The buyer is able to escape the tax. They have a fairly elastic demand curve. So when the price of tickets start to go up, they substitute other forms of entertainment for basketball games. But the seller, they cannot escape the tax. So they will take on more of the tax burden. What if we have a situation where both the price elasticity of supply and the price elasticity of demand are fairly elastic? When we put in our tax wedge of $1, what we see is that there's a big decrease in the equilibrium number of transactions. And that's not surprising because in this case, both the consumer and the seller are trying to escape the tax. If you put the tax on the consumer is going to find another substitute for potato chips, corn chips, or pretzels, or cheese curls, something like that. And the seller, likewise, what we see for them is that if a tax is imposed on them, instead of producing potato chips, they produce some other alternative form of junk food. So the big thing here that I want to emphasize more so than the burden is that when you have elastic demand and elastic supply, you're going to lose a lot of transactions. And what that means is you're going to get a really big deadweight loss. And finally, what if we impose a tax on a product that has inelastic demand and inelastic supply? In this case, let's go ahead and put in our tax wedge of $1. The big thing to notice here is that because neither the consumer or the producer can escape the tax, you only have a small reduction in the number of transactions. The deadweight loss is going to be much smaller if the demand and the supply curves are relatively inelastic. So that's what I want to emphasize in this particular slide, is that the value of the deadweight loss will be smaller if both the demand and supply curves are fairly inelastic. So for example, even though both of these curves are fairly inelastic, if it were indeed the case that the price elasticity of demand is less than the price elasticity of supply, and both of those are less than 1, then the consumer would pay the larger proportion of the tax. In the previous example, if both curves are fairly elastic as far as who's going to pay the burden or the majority of the tax, that ultimately depends upon whether the price elasticity of demand is less than the price elasticity of supply or not. So in this case, if they both are fairly elastic and the price elasticity of demand, though, is smaller than the price elasticity of supply, it's going to be the consumers who pay a majority of the tax.